Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins and thanks for watching. Well, August was the worst August in 17 years and September has continued the volatility that we saw in August. Up 300 points, down 300 points, up 200 points, down 100. The chart behind me shows the volatility that we've seen so far in the first 21 days of September. Last week we had the Federal Reserve decide not to raise interest rates. I think the market was somewhat disappointed that it didn't raise interest rates, but I don't think they're going to raise interest rates before the end of the year. And simply because while the mandate of the Fed is to make sure that there's stimulus to provide employment, the unemployment rate at 5.1% is a bogus number, because not counted in that number are 93 million Americans, a record high, who either unemployed, have lost all their unemployment benefits, and are not counted in determining the unemployment. If we had the real unemployment number, including those 93 million people, we would be closer to 11% unemployment. So the economy continues to be weak, tepid, below 2%. Inflation is on the downside, is a positive. Part of that is energy prices, and I think energy prices may, at the pump at least, continue to fall for a while. But I think that the Fed is basically doesn't have a rationale to why they raise rates. Now, if you read a bunch of the commentary that I do, everybody's talking about the Fed's going to do one and done. Well, if the Fed's going to do one and done, why are they doing the one? Is it a message? Is it a statement that the Fed says we can raise interest rates? And how much are they going to make it one and done? I think that we just haven't figured out that an economy growing less than 2% on average is not a robust economy. And even with low interest rates, it's still not stimulating significant amount of growth. And so the Federal Reserve raising interest rates makes no sense to me. The economy is underperforming, inflation is well in with hand, and we've got 93 million people out of work. So I would be surprised if the Fed raises rates by the end of December, as some are projecting. And if they don't, then they won't probably play with interest rates in 2016 because of the presidential election. So we could be looking to after the presidential election in 2016. So probably looking at if there's going to be a rate increase into 2017. But my guess is that the economy is going to flounder in 2016, that it's going to continue to contract, and it may get to zero growth in 2016, which would then cause the Fed to do what some people are talking about, having a negative interest rate. Now, that's happening in Switzerland and Germany and some other European countries. It's where you put in money in Treasury securities and your rate of return is negative, meaning you lose money, negative returns. But it will help force money into the markets and alternatives into stocks and longer dated bonds. So I think that that's probably not going to happen this time around unless we get a severe recession. But I think we could have a significant slowdown in 2016, which puts the Fed on hold for some period of time. So volatility is with us. Don't look for it to change much, except it's going to go up and down a lot. We're getting paid with our dividends and our interest, and checks are a wonderful thing. So that's it for now. Should you have questions, please feel free to give me a call or send me an email. This is Dan Perkins, and thanks for watching.